Hi, and welcome to CPA Canada's post-budget debrief. I'm your moderator, Sunny Freeman, Director of Communications here at CPA Canada. And joining me are our VP of Tax, John Oakey, and our Chief Economist, David-Alexandre Brassard. Thanks for joining. The three of us were in the budget lockup yesterday, and we've sifted through the budget. And let's face it, there weren't very many surprises yesterday. In fact, a lot of the spending announcements had been made prior to yesterday. So that left one key question, which was how was the government going to pay for all of these spending priorities? And one key theme has bubbled to the top, and that is new tax measures aimed at wealthy Canadians to help pay for spending measures. And the sort of word on everyone's lips right now is capital gains. So, John, I was hoping to start off with you could tell us a little bit about the capital gains inclusion rate and exactly who it will impact.
Okay, so the measure that was introduced in the budget was to increase the capital gains inclusion rate from 50% to 2/3. And that will apply to corporations, trust, individuals. Now, the difference between corporations, trusts, and individuals is that individuals will have a $250,000 threshold that they have to get over before they hit that higher inclusion rate. Corporations and trusts, it will apply to them immediately. Now, this new measure will start on June 25th, 2024. So there's a couple months that you have available in order to start planning to, recognize the new inclusion rate.
And I know you've talked a bit about it is aimed at wealthy Canadians, but there are different segments of the Canadian population and middle class people as well who could be tied up in this. Could you elaborate a little bit on how others could be impacted?
Yeah, so that's a really good point. So it's kind of marketed in the budget as this is applying to the wealthiest Canadians, and as Chrystia Freeland had said in a previous news announcement that we're not raising taxes for the middle class. Well, it can't be said that that's correct categorically because there are life events that will happen for pretty much anybody where in a particular year they may have capital gains occurring in that year that would exceed the $250,000 threshold. And some really good examples would be if you had a cottage and you've owned the cottage for a long period of time and it's appreciated in value and you have this inherent capital gain. Well, if you sell that in 1 year, that could put you over the threshold, increasing your overall tax burden. If you were investing in rental properties for, as part of your retirement portfolio, and then all of a sudden you now need to diversify because you're entering your retirement years and you want to move it into a safer investment, well, that could trigger capital gains in that particular year. And another one, which hasn't been addressed yet, is estates, right? So people that die and don't have a surviving spouse to transfer their assets to, all of their assets will be deemed disposed of. And because if they have assets with appreciated value, that those capital gains could get triggered all in one particular year, which could put them over the threshold. So it is specifically earmarked for wealthier people, but it will have an impact on other people when they have these life events that occur in one particular taxation year.
And I know you've been getting a lot of questions already from media, and I know your colleagues are getting a lot of questions streaming in about how this is going to impact people. What should I do? It comes into place June 25th. So what do you expect in terms of activity for CPAs in advance of that date?
Yeah, so this is something that we weren't expecting because we always predicted that if they ever bumped up the capital gains inclusion rate, it was going to be, effective as the announcement date, which would be the date of the budget. So we're very surprised to see that the government's provided, a couple months to plan. When you look at the numbers in the budget, they're expecting about $7 billion in the current fiscal period as a result. So I think the 2 months is really designed to allow people to liquidate their assets and trigger the gains before the new inclusion rate goes into effect. Now, the problem I have with this is there's a lot of number crunching that's going to happen. It's not as simple as saying, oh, well, we just need to sell everything before the inclusion rate increases. You really got to go through and crunch the numbers. One of the problems is alternative minimum tax, which we have talked about before. The changes to the alternative minimum tax actually take effect as of January 1, 2024. And so if you sell your assets before the inclusion rate increases, you may be subject to alternative minimum tax and you may not be better off. So there's going to be a lot of work for accountants to crunch numbers, look at plans to try to figure out what's the best thing to do. And the other problem with this is we don't have any tax legislation to base this on. So in the budget, when you look at the notice of ways and means motion, there was no detailed tax legislation to go with this announcement. So we have 2 months to plan what we're going to do, but we don't have any specific detailed rules to plan with.
And you said it's a busy time for CPAs anyway.
And it's a very busy time. There's a lot of chartered professional accountants out there that have December year ends that have a June 30th filing date. And so everyone's going to be busy right up to the end of the June. So it's going to be a lot of work over the next couple months.
And there have been some headlines even in the past 24 hours since this has come out about how this tax measure will impact productivity and competitiveness for Canada. And I'm wondering, David-Alexandre, if you had any thoughts on how much this will hamper or affect productivity and competitiveness.
So this is a good question, Sunny. Maybe to set the table, GDP per capita, which is the amount of value that we create per worker, has been going on for several quarters. Labor productivity, it's on par with 2017, 2018 levels. And it's predicted that Canada is going to be on the tail end of OECD when it comes to growth. So to me, the issue that I see with this budget is the message that you're sending to the business community, and how we can tax you more if we need the revenue. And it's recorded in a moment where the business community is not doing great. When you look at the economy and you want to know how we're doing, the number of active businesses is a great indicator. I show that indicator on our data portal for members on cpacanada.ca. It's been ticking red for quite a few months. So ahead of the GDP that we expect to stall a little bit more. And the other concern is we've got an aging population. Entrepreneurs, by design, they're a bit older. They can take more risk and invest. So there's a big retirement wave for entrepreneurs. And what we've seen since the pandemic, I think I wrote a piece about that in 2023, where we have dwindling numbers of entrepreneurs. And I looked at the numbers just this morning, and if you look at the percentage of entrepreneurs in the overall workforce, we're at 3.5%. It's the lowest it's been since we recorded that statistics in 1976. So there's a question about what's the message that we're saying to people who want to get into entrepreneurship.
Wow. So there was a tool, a capital gains tool in the budget aimed at entrepreneurs, the Canadian Entrepreneur Incentive. And I'm wondering, John, how much you think, maybe you could explain out what that is a little bit, and then how much you think that will go some way to help alleviate entrepreneurs from this.
Yeah, so it's a measure that was introduced. It's very specifically targeted, and the way they targeted this Canadian entrepreneurship incentive, they targeted for small business corporations that are Canadian controlled private corporations. So it's a narrow it's a narrow scope from that point of view, but it's a narrow scope specifically designed for entrepreneurship. So if you look at the small business corporation, the rules around that are really trying to capture active businesses. But it doesn't stop there with narrowing the scope. It further narrows the scope with more criteria, making it very specific, excluding certain sectors, excluding professional corporations. And so it is a very, very narrowed tax incentive. And you can see it in the numbers. Like when you look at the numbers in the budget, you have, a capital gains inclusion rate increase that's bringing in $20 billion over 5 years. This measure, from a cost perspective of the government, is only $625 million over the same period. So it's really not a lucrative incentive because it's so narrowly targeted. And even if you can, fit within the very specific criteria, they're phasing it in over a 10-year period, right? So the $2 million lifetime limit that you get, and what the incentive does is, with this lifetime limit that will be increased $200,000 every year until it hits $2 million, what it does is the gains that you have within that limit, it will reduce the prevailing inclusion rate by half. Like, and that's effectively what it's doing, is bringing that inclusion rate down. But once again, it's so narrow, it's not going to be that beneficial for the general entrepreneurial population.
So given that they are expecting about $20 billion in revenue from capital gains, I know that that was meant to go some way to pay for, over the same period of time, about $55 billion in new spending. Overall, David-Alexandre, I'm just wondering what direction you think that this budget is setting us up for taking the economy into.
We keep heading in the same direction, which to me is the issue. If I explain my thoughts a bit more carefully, for the last year and a half to 2 years, the economy has been holding on stronger than expected. More recently, in the budget 2024, population growth was strong, and prices remained relatively high. So this means that nominal GDP for budget 2023 is on par with like the upside scenario that they printed in the fall statement. So a better economic outlook means more revenue for the government. But as I said, over the last year and a half to 2 years, that's been happening. And every single time the government has spent the additional revenue and then some.
Right.
So if you had that propensity to spend more and more, deficit has worsened by 10 million in the budget. So that's a concern. And if you take into consideration that our fiscal anchors are pretty weak, what we want is a declining debt to GDP ratio over the long term. When you think about it, the denominator over here is nominal GDP growth. If your population grow, price grow, the denominator grows, so your ratio goes down almost automatically, so not very strong. And the other one is the 1% to GDP limit to deficits, and it's punted in the last for the next 4 years. So there's question marks for me on that front.
Yeah, and to add on to that, what, you know, when you're looking at the budget, you're looking at the numbers, you know, you have your revenue, your expenses, and at the end of the day, you either have a surplus or a deficit. And if you're increasing the expenditures and you're trying to manage the deficit, as we've seen in this particular budget, there's one thing left in this equation, which is on the revenue side.
Yeah.
And in order to generate the revenue, you have to change the taxes, right? So we saw that in this budget, but we've seen over the last number of budgets, there's been lots of measures that have been very specifically marketed towards, you know, either private companies or various other what they call loopholes in the system. And in the tax system, what businesses are looking for in order to invest into Canada is predictability, certainty, and not to have an administrative burden on top of the, you know, of your entrepreneurship. And we saw that with the trusts, you know, a significant administrative burden. We saw that with the underused housing tax, and there's a whole slew of tax measures that are still outstanding. Like when you look at the budget documents, there are 2 pages of previously announced outstanding measures which are still outstanding. So, and this has a dramatic effect when people are trying to predict, you know, their outcomes and trying to, you know, have certainty with regards to, you know, what their tax outcomes are going to be.
So we haven't done anything to make the tax system more efficient in this budget with the capital gains new
Correct.
tax measures. Now on the capital gains tax measures, they are meant to raise revenue, and a big chunk of that spending in the budget was on this Canada Housing Plan. We've gone through it, and overall, I would love to know your thoughts on what you like about this housing plan, because we do know that we have a very real housing and affordability challenge in Canada. So that needs to be addressed. So what do you like about it, and what don't you like about that plan?
You're right in saying that the housing plan is welcome, although a tad bit late, in my opinion. Before I jump into what I like and what I don't like, there's a big question mark in terms of capacity. The housing plan is supposed to double the construction levels that we have across the country. Keep in mind that the construction workforce since the 70s and the 80s has about doubled. And even at the pandemic peak, when we had a lot of money going into constructions because people were saving more, we've only managed to have an uptick of construction in the 5 to 15% mark. So thinking that you can double with a housing plan over the next 7 years, to me, there's a capacity concern there. And if you throw more money and you don't have the increased capacity, there's always a price consideration. Are you going to increase the price of construction? And to me, that's a concern because we not only do we need housing, we need health related infrastructure. We got an aging population. The roads always need repairing, and if we do have an increase of price in construction in real estate, it usually spills over into other sectors.
Absolutely. I mean, one focus is meant to be on the younger generation of home buyers. And so there were some incentives in there to try and get younger people into the housing market, because of course that's a huge challenge right now. I'm wondering what you made, John, of some of the measures specifically aimed at those type of home buyers.
Yeah, so one of the specific measures, which was announced before the budget,
Mhm.
was the increase in the home buyers plan withdrawal limit. So they moved it up to $60,000. And, it's a good measure in the fact that it doesn't require significant legislative change. It doesn't add a significant complexity into the system. From a beneficial point of view, will it accomplish its objective? It's when I look at my own kids and I think, okay, well, where are they going to get the money to fund, the $60,000? That would probably be me, right? So if the incentive is to try to get the generation that's looking for housing to, put money away in order to buy their first home, that's probably not going to happen. It's probably going to be the generation that currently has the housing that's going to have to help fund it for the generation that needs the housing. So it's an incentive that is not problematic. It doesn't add problems to the system. I don't know if it's going to be significantly beneficial from the point of view of creating that first-time home buyers to save money. And there still is the tax measure that was introduced before, which is the first home savings account. And so that's another vehicle that was introduced as well to try to help individuals to save for the first time home.
And there's other measures that you've been looking at in there too that you're finding kind of double-edged sword.
Yeah, when building on what John said, whenever we support the demand for homeowners, I don't think the context is ideal for that. Meaning, is it simply going to translate to increasing prices? And also, there's mention of a 30-year amortization.
Yeah.
Again, when your country is in the top 3 of the level of household debt, I'm not convinced that kind of measure is really where we want to go. Although there's some stuff that I do salute in there. The incentives that the incentives to direct real estate investors toward more building. To me, that's a good thing. There's also some stuff around productivity and innovation in the construction sector. To me, that's a big thing because, as I said earlier, we've got twice the construction workforce. We're not building twice more, so there's some concern there that can be addressed. I also like the idea of conditional funding towards transit from the federal government. This one, as you said, was really double-edged because it's really all about the implementation. Can you be flexible enough? Can you have compliance that's not too costly and on the administrative side as well? So some consideration to take in there.
Another interesting thing I thought you noted was that it is an ambitious plan, but the levels that it's aimed to get to also happen to coincide with the immigration targets.
Yes, whenever you're looking at housing, there's housing supply, so how much we got, how much we're building, and there's housing demand. Right now, the big ticket item on housing demand is immigration, whether that's permanent or non-permanent. In the last year and a half, it's more non-permanent. And I do find it a bit strange that the overly ambitious target, as I said, of doubling construction level kind of aligns with our immigration targets. So there might be more thinking to do on the housing demand front from the federal government, which is in their ball court. So they need to look there instead of simply looking at what's in the provincial and municipal ball court, like density and permit delays, for example.
Interesting. And then there were other measures in the budget that will affect CPAs, and I'm just wondering if you have any other tax considerations that people should think about.
Yeah, so as I sit back and think, there's 2 other measures. One was the employee ownership trust. So in the fall economic statement, they made the announcement that they were going to provide a $10 million exemption for any capital gains for an individual selling shares to an employee ownership trust. So in the budget that was presented yesterday, they actually provided some of those details. Now, the problem with some of the details is they're very, once again, it's very narrow. So it's a narrow scope. So it'll be interesting to see going forward how many people can fall into the narrow scope of the $10 million exemption, and will it really be as beneficial as what as what we were hoping for. So that's another measure was there. Another one is with regards to Canada Revenue Agency. So in the budget, there's a proposal to provide a little bit more power to CRA with regards to gaining access to information that's requested through an audit process. And if the information that they're requesting is not provided, the budget is proposing to allow Canada Revenue Agency to send a non-compliance notification to the taxpayer. And what that really does is it provides an opportunity for CRA to assign a penalty to the taxpayer for non-compliance, as well as extend the normal reassessment period until the taxpayer actually complies. So it's providing a little bit more power to CRA, because normally what would happen is if a taxpayer is not complying, then CRA would have to go to the courts, get a compliance order, and then if the taxpayer is still not complying, then they would have to go to the courts and have them in contempt of court in order to apply financial penalties. Well, this measure will allow CRA to sort of skip that process and have the ability to assess a non-compliance notification and assess a penalty right away, which is, I think it's $50 per day, up to a maximum of $25,000. Plus, like I said, extending the normal reassessment period while that notice is still outstanding and the information's not provided. So that's something to definitely be aware of, because that puts the power in CRA's hands. And as the old saying goes with regards to Spider-Man, with great power comes great responsibility. And so we certainly hope that CRA will have some good policies and procedures in place to make sure that that notification is used appropriately.
Could that have implications for CPAs, tax practitioners as well?
Well, it would, because now you have to make sure that you're managing the situation when when you have taxpayers being audited, or if you're in a business and you're being audited either as an individual or as a representative of your employer. And it's really important to manage the situation. So when CRA comes into audit, I mean, their purpose is to verify the integrity of the tax system, which we all agree with. The system is designed so that people comply, and you need somebody to enforce that compliance. So the fact that CRA is coming in to enforce the compliance is a good thing. But what you want to make sure is that they're following the procedures and their policies, and they're requesting the correct information, and they're not sending you on what we'd say is a wild goose chase where you're gathering erroneous amounts of information for no real reason. So this is another tool that CRA would have to ensure compliance. We just want to make sure that they're doing it within appropriate policies and procedures, and doing it in an appropriate way to minimize disruption to the taxpayer.
And speaking of the power of the CRA, one criticism or something people were looking for ahead of the budget or were focused on is the size of the federal workforce, including the CRA. Was there anything in the budget that addresses the growing federal government workforce?
So the government was shy on that end. Last year, the first step was, okay, let's cut consulting costs. And let's cut travel costs. So kind of an easy bargain. This time around, what they want to focus on paying for increased cost with the current budgets, and they're going for attrition, which means they're not going to replace retirement leaves. Although it's supposed to reduce workforce size by 5,000 in a few years out of an over 350,000 workforce. So I would say they're not very ambitious on that front. I would have liked a little more review of their spending before increasing revenue, because I think there's stuff to do on that front.
Interesting. And then how does the size of the federal workforce, I've been hearing a lot about that, but how does that play in or tie into the economy overall?
Okay, so first off, if I take us out of the current engineering economic slowdown due to higher interest rates, 2021, 2022, we have a labor crunch. We have an aging population. This labor crunch is going to come back once we bring interest rates back to a more neutral rate. And private sector and public sector, they're fighting over the workers. So if the public sector is growing at the speed that they're growing, they're going to take workers away from the private sector. So there's a growth issue for our private sector there. The second element I would say that is an issue for me, I said it, the 1.5 to 2 years that we've had, we have better revenue, but it's a cyclical thing. Like the forecast was better than expected, and we're using that to fund workforce spending, which is structural. So are we creating a structural deficit and making it harder and harder to get back to a balanced budget? And the third consideration has to do with the interest rates. The Bank of Canada is putting a very restrictive monetary policy. And if your government is spending more and more, the fiscal policy, they kind of work in opposite directions, meaning that we might need to have interest rates higher for a tad bit longer due to those spending. So there's that to consider.
Which is true, because I mean, forward looking, I know a lot of people are looking to the sort of June, July interest rate announcement to look for an actual decrease. Do we see that? Did the budget have anything to foreshadow about that, or just where do we think that's headed now?
So to me, the picture hasn't changed that much. The 50 billion in over 5 years is the 55, sorry, additional spending. I don't think it's going to tip the scale. What we saw yesterday was also a day where we released the new inflation numbers. So we're still under 3%. But what we saw in March is that we're looking at price from month to month, not only year to year. And there was an uptick in there. And to me, the Bank of Canada has been very conservative when it comes to decreasing rates. They're really looking for that those prices going down. So we're still in the June is still in our purview. Could it be July? Maybe.
Okay, great. And I know there's been questions in the chat coming through. Our team is looking through those right now. And we will have more information about the federal budget, including some answers to questions in the chat on our website, cpacanada.ca. So look there in the coming days for any more information. Any parting words, John? Any last thoughts on the budget takeaways, or do you think we've covered everything off?
Well, we haven't covered off everything. Obviously, there is other stuff in the budget. I mean, one quick note is with the alternative minimum tax, which, as I said, comes into effect as of January 1, 2024. The original proposal had a negative impact on the charitable sector. And so finance did address that. They did change the rate a little bit, so I don't know if they've eliminated the problem. There's going to be some number crunching to see if they've actually eliminated, what was perceived as a big problem. But they did at least address it and change it from 50% to 80%. So hopefully that will mitigate it. We'll find out in the coming weeks as people start crunching the numbers to see if that solves the problem or not. Other than that, there are a number of other measures in the budget, but I think we've covered some of the most important ones.
Amazing. And I know you're hard at work. You hear from members, you communicate those concerns to the CRA. So thank you for that. I'm sure you will be doing that after this budget as well. Thank you, David-Alexandre. This has been great and insightful for me. So thank you all for joining. Bye.